All right, Tina. So thank you so much for doing this. I really appreciate you taking the time and just really giving us an opportunity to ask questions and really find out what's going on in the Gilbert and Greater East Valley area. And so with that said, if you could just give us a brief introduction about who you are and what you do, that would be wonderful.
Sure. Yeah, I am a local housing analyst. I am with the Cromford Report, and what we do is daily analytics on all forms of housing. So new home construction, permitting, flip investing, buy and hold investing. What we do is we analyze all of the undercurrents that push prices up or down, or otherwise what influences demand and supply. So we basically do that just for the greater Phoenix area. And it's just, I guess,
you've been busy.
We're like the local nerds. We're your nerds.
The information that you give us is so valuable because it really helps us to just really know what's going on such a bigger scale. And that's super helpful because kind of like what we talked about earlier, I get asked every day by multiple people, what's going on? What do you see happening? You know, they want me to predict the future, which I always tell them I cannot do that. But I can tell you what I'm experiencing today. And so I thought, Tina, it would be so great if you could share some of the things that you're seeing, specifically as it relates to Gilbert. One of the things that we were talking about, because I get this question all the time, is, you know, is now a good time to buy? What do you think? And so I'll share with them kind of my thoughts and things that I gather, especially from the Cromford Report. So I would love to hear, Tina, what would you say to that question?
Well, you never want to ask an analyst something like that because we're going to fire back probably about 5 or 10 other questions before we start giving advice on that level. But I would say it really does depend on why you're buying the house. You know, whether or not it's a good time to buy or sell depends on what your personal situation is. And I would never say it's a good time for somebody to buy if they're not secure in their job, secure that they're going to, you know, stay in the home for at least 3 to 5 years. They're not secure with the payment. They need to feel secure about it. Now, if what makes them insecure about purchasing now is that they think that they're going to get it, you know, at a lesser price down the line, I don't think that's a good reason. That's because mainly housing has always been a long-term investment. You should not be really timing the market unless you plan on flipping the home. Those are the only people who should be timing anything.
That's a good, yeah.
Regular people for like us, we're going to plan on living in the homes, you know, raising families or retiring or whatever. It needs to hit our boxes. It needs to fit our budgets. And it needs to be something that you expect to ride out a lot of these ups and downs, because that happens. You know, there is an up and down period. And I think when it comes to predicting the future, which we don't do and which realtors don't do, what we can do is say, well, under certain circumstances, there are things that are reasonable to expect. And there are other things that are not reasonable to expect. It's reasonable to expect that we might hit a little bit of a recession after this. It might, you know, it's possible, maybe we might see property values fluctuate. Now, whether that's 5%, 10%, we don't know, but it's not reasonable to expect a crash, a 45% drop in prices, like what happened in 2008, or a 55% drop, and we saw catastrophic drops in pricing. That is not reasonable to expect in this market. The numbers literally do not support that. But if somebody's trying to do the analysis for themselves, what I would say is do the math on your payment. What does a 5 or 10% drop in your price point mean for your payment? Now, if you decide to wait, what is the risk of the interest rate going up even 0.25%? Do that math on your payment for your price range and see which one hurts you more or benefits you more. And I would probably gather in some of these price ranges, 0.25% increase in your interest rate hurts you a lot more than a 5 or 10% drop in price helps you.
Yeah. So that's a really great point in the interest rates being as incredibly low as they are. I think it's probably the lowest in my entire life. And being able to buy a house and get interest rate in the low threes is insane for a 30-year life of a loan. So there's a lot of value in that. Can you tell us what you're seeing in terms of people putting their homes on the market, what's going under contract, things like that? What are you seeing in that regard?
Well, let's, before we talk about what's going on in the listings and the supply line, let's talk about real quick what's happened with demand. So a lot of the headlines that are predicting crashing and stuff like that are referring to a drop in demand, which we did have. We had a lot of people who were like deer in the headlights when this whole thing went down, 6 weeks of drop. So we had a 39% drop in the number of weekly contracts. In the last 3 weeks, though, we've seen a 32% increase, and Gilbert is almost all the way back to where they were. As of last week, they were back to where they were at the level of weekly contracts coming in prior to the whole COVID everything. So in that sense, the demand has pretty much recovered. But what happens with price, if you have a drop in demand and you have a drop in new listings and supply at the same time, you don't see a big response in price. It's a self-regulating thing. People who don't need to list their home don't list their home when there's not enough people there. So that's what a normal, healthy market does. In order for it to be unhealthy, to be a precursor for prices coming down, you have to have a seller who has to sell, where you still see listings coming on the market despite a drop in demand, and they have to sell. They can't take it off. That is a precursor to property values coming down quite a bit. We have not seen that. We actually saw new listings came down 20% in the month of April. So a lack of new listings coming on, and we actually saw an increase in contracts going up, tells us that if there is any drop in price, it's probably going to be temporary. And here's the thing that buyers have to understand is that price is a lagging indicator. By the time that price is recorded and you find out about it, it's too late. It's too late. You're past the party because you're finding out with everyone else. What you have to track is what's happening right now. And where are the contracts coming in right now at list price? And in some price points, you're seeing that the dollar per square foot for what's active at contract, that might be coming down now. That's when you have to act. You don't act after they close. So what we're seeing is everything that went on the market and went under contract during this pandemic, we have to wait for them to close in 4 weeks to see what that price response is.
Right.
So you can't sit there going, oh, I'm going to wait until I find out for real. When by the time you do, it could be the party's over. There's like 4 chips left in the bowl.
Right. I hear that a lot. I'm so surprised that demand hasn't gone down, that people are still, and I think to your point, it's all relative, right? Maybe we don't have as many listings, but there's also less buyers. But we are starting to see that start to change a little bit, right? People are feeling more comfortable with putting their home on the market. The buyers that have been maybe sitting on the sidelines waiting are starting to come back to the market. Yeah. And so we're starting to see that confidence, I think, for consumers out there to start feeling more comfortable with doing things, right?
Well, exactly. And so even though we see some of these headlines that are scary, the fact is that when that's not what the actual buyer or seller are seeing in their immediate area, if they don't see it, then they start to be like, well, maybe that's not applying here because I'm seeing all these homes go on the market and they're still sold in a day, or they're still sold, they're on the market for 2 weeks, or they're seeing multiple offers as a buyer. They're like, these are not corresponding to what I'm seeing. And on top of that, when we look at 2008 versus today, 2008 was the aftermath of a massive amount of investor activity, okay? Massive amount of investor activity doing things that we don't have time to explain right now. But what they did is they pushed the prices up beyond affordability for family making the median income. And so when they lost their fuel, if you will, which was the loose lending practices and all of the funding that they were taking advantage of, when they lost that and they pulled out of the market, the prices were so high that a family making the median income couldn't afford them. So they weren't jumping on them. They were beyond their reach. But that's not what happened this time. So once again, this whole cannonball of the virus came through, put a big old, hole in our marketplace, because that's when anybody who was fueled by Wall Street, which could be your corporate cash buyers, a lot of them, Wall Street, anybody who was luxury, who cares about their portfolios for high-end purchases or even high-end lending, any of that suffered. But what it left was this little window of opportunity for regular buyers and sellers to come in and get a home without having to compete with a cash buyer for a bit. And what they saw on their feed were these homes coming up that after a year or so, or 6 months or so of really losing out to these types of buyers, they're seeing homes that are in good shape come in on the market. They're in their price range. They're affordable. Because the fact is that what was left behind was an affordability rate of 65%, which means that of the families making the median income of $73,000 a year here, it could afford 65% of what was selling. So what they saw was homes that they could actually live in, the homes that they would hit their boxes, that they could afford. And they're seeing them and going, well, how long am I going to stay in this house and wait for somebody else to get that?
Mm-hmm.
And so that's what I think that the headlines, if it doesn't ring true for somebody's personal experience and their personal environment, then they just start acting on what's best for them.
For sure. So it kind of leads me to a point, and I don't want to ask you to specifically comment or anything, but as it relates to the iBuyers, right? We saw those companies sit back and say, hold on, we're not going to do anything. We're going to completely stop, right? Anything that we're either not fully executed on, we're going to cancel, or we're going to put things on the market right away, right, to get them moved. So we saw that big pause. Well, they've just started coming back into the market, and I think that says a lot too about what is going on, right? Those companies only thrive in a seller's market. If it was a buyer's market, those companies wouldn't thrive. And so I think that's really telling too.
Yeah, because the fact is that their business model requires, for them to really thrive on their business model, they cannot hold a property for very long. And in buyer's markets, the very definition of a buyer's market is you're going to be on the market longer. And the longer you're on the market, you're paying taxes, you're paying HOA fees, you're having to maintain the property. And as you go into summertime, you need to have some air conditioning in there, possibly. And so the cost for holding is longer in a buyer's market. And not only that, in buyer's markets, your prices are declining. You do not want to be flipping homes when prices are on the way down. It's just super risky. So they generally like to be in seller markets because prices are rising. There's still a lot of demand, so they can keep their holding times very low. That's the whole
premise of their business model, right?
Yeah. So if you're a seller and you still have investors calling you and texting you and hounding you to see if you want to sell, by definition, that does not happen in a buyer's market.
That's such a good point.
Still in a seller's market.
Yes, such a good point. I get clients that say, Janine, I get so many calls from people wanting to buy my home or saying that they want to buy it. That just right there tells you everything. Can I ask you, Tina, specifically if you've seen a difference in price ranges? So I know in my business, we've seen that $500,000 to $600,000 price range probably take one of the bigger hits versus some of the lower price ranges. Do you see any of that reflected in the greater market?
Well, yes and no. The interesting thing about the high-end market is that those sellers are not desperate. In fact, a lot of them over $1 million just took their ball and went home. They left the game altogether. So what's left are the people who have to sell their house. The people who are like, well, I know it's not the best, but I guess we'll just drop the price and get what we can get. But the fact is that all of our price ranges, despite some of the increases we saw in supply, are still below 2019 levels this week compared to this time last year. We're still 20-30% below in some cases below last year in supply. So the fact is that the fact is that
you were just saying that supply is still low, and so compared to last year, which is so interesting. And then the fact that interest rates are lower than they were last year, oh my gosh, like even better opportunity. If they're, and I think to your point in terms of motivated sellers and things like that, we are seeing people stay in the market that are motivated, that have a reason to sell, which is fantastic.
Yeah. And so I'm sorry I lost my train of thought. Somebody came through the office. And
Oh, no, that's okay. I hate when that
maybe
happens.
you can cut that part out. But but what I wanted to get across was that over $1 million, the supply is actually below, had continued to drop throughout the COVID situation, which means that they're self-regulating that price. So you're only going to get those that really need to sell and are willing to negotiate on that level. But this is what I do want to say is coming up, and this has been good for some buyers, is that sellers are more willing to negotiate now on seller concessions. So what we did see is, even though the prices are still staying pretty stable in most price ranges, what we've seen is the seller concessions, paying closing costs and things like that, actually went up for 3 weeks in a row. So we went from 18% of all closings having some form of seller concession to 24% of all closings having some form of, in a 3-week period. So that tells us that there's a little more wiggle room for those buyers. It doesn't mean that they're going to get a bargain. What it means is they'll get a better house. You know, like they're not having to compete with as many people. And in certain areas, just so you know too, if I've heard people say, oh, I had a buyer, they were a first-time home buyer, and the next thing you know, their parent calls them and they're like, why are you buying right now? This is a terrible time to buy. It's the worst time to buy. Well, guess what? Their parents live in a more expensive area of town that was hit the most. Yes. So if they're coming in from, say, North Scottsdale, of course, it's a terrible time, you know, in this market right now, because it is uncertain with the stock market and all of that stuff. That's what drives those areas. But if they're in Gilbert, Chandler, South Phoenix, Laveen, Tolleson, most of the West Valley along the I-17, Moon Valley, North Phoenix, all those areas still have more under contract than what's literally available for sale. So even with 6 weeks of declines, our market was so hot, it was not enough to bring us into a balanced market, let alone a buyer's market. We are still in a seller's market, despite all of that.
Right. So what, you know, before this all happened with the pandemic, we were seeing the market was absolutely crazy, right? It was tons and tons of offers, not just, I mean, it was multiple offers.
Over asking price. Waiving appraisals.
Get in. Yes, waiving appraisal. And it was, honestly, it was a little bit stressful. I know I talked to my realtor friends, like, this is just craziness. So this pandemic happening has kind of slowed a little bit of that frenzy down, which I think is much better and much better for the long term of the market. And I know I have people, and we were kind of chatting about this, and I'd love for you to speak to this if you wouldn't mind. I have people that say, okay, you know, we're headed for a recession. We're going to see a market crash. I think I want to sell my home now while values are high, and then I'm going to wait out the market, and then I'll buy low. What are your thoughts on that?
I think that's a terrible idea. I don't know how else to say that. That's a terrible idea.
Okay.
If they can afford their house, they can afford their payment, they're happy with the house, they're happy with their payment, hold on to it. Why? Because that's something you can control. You're going to go into a rental that you have no control over. Let me tell you something. If we go into a recession, if you cannot pay your rent, you are at more risk of getting evicted than if you owned your home and are threatened with foreclosure. Because look how much support homeowners have gotten right off the bat in this thing to keep them in their homes. There's way more support for home ownership than there is for rentals, because guess who owns the home for the rental? The landlord. So yeah, there were some issues along those lines, but I think that I think overall, if you like stability in your life, why are you in this house? Why do you own this home? Right. Is it because you want to pull money out of it and constantly like use it for what? So what I would do is I would look at, again, doing the math on your amortization schedule. If you keep this home for 5 more years, how much equity will you have? Is that more than what you think you're going to get this home for later?
That's a good point.
You know, because when you look at that, the longer you have that mortgage payment, the more principal you're paying over time, it builds. And
Mhm.
so you might find that if you held on to this home longer, you might have 30 grand in equity that you've built just from making your payment without any appreciation whatsoever on your home. You could actually be building that equity up. And are you going to get a home for $30,000 less? And if you are, then why bother? It's a
Mhm.
wash.
Mhm.
You know what I'm saying?
Right, right. Or if you want to sell, because if there's a motivating factor, right? Maybe your family's grown, you need more space, or maybe you're downsizing, your kids are going out, and there's still a reason to sell. It's okay to buy if it matches up with what's going on in your life. I don't think that we have to, I think people, because so many of us lived through, and maybe we're even hurt by what happened in '08 and '09, that it makes people afraid, right? They don't want to be stuck upside down on their house again, or in a bad situation where they're facing a potential foreclosure. And I think that fear is what we hear driving people. But to your point, it is a completely different situation than it was back then.
Oh, I can't tell you the night and day. People who are afraid of that are just people who were not very intimately involved in what caused that, with a full understanding. People who lived through that, maybe they were surprised by it. Of course, there's a lot of PTSD about
Mhm.
that period with professionals and homeowners alike. But the fact is that people don't walk away from 50 grand in equity. The people who walked away from their mortgages, which some of them were strategic, mind you, people who had no money of their own in it. None. They didn't have a down payment of their own. They got down payment assistance, or the lenders weren't even requiring it. They were giving you 110% financing loan to value. They started off upside down. Then they got an adjustable rate mortgage, which fluctuated their payment when the interest rate rose. We don't have that now. They also had interest only payments. So while they were making their payment, they weren't building any equity on it. So by the time they lost their job in construction or tourism or whatever, they look at their equity build and their interest rate that went up, and now their payments have gone up, but they can't afford it. They have no equity in the house, and they never put a dime of their own money in it. You have that now. Now the interest rate can fluctuate anyway, and your payment stays like this.
Mhm.
And our payments are so low. We're as low as they were in 2005, in the early 2005. I mean, literally 15 years. You could have the same house, the payment, principal and interest is only like $15 apart. So
Amazing.
you could have not had a raise for 15 years and still afford the same house. And so I think what people have, they focus too much on the sale price of the home. And many new homeowners have done this, or I should say first time home buyers have done this. They focus so much on the price, they haven't been watching the payment. You know, as the prices have been rising, that interest rate actually was taking their payment. So their payment actually declined for a year by like $200 a month. But all they could see is this price going up, waiting for the prices to go down when their payment was going down. And they weren't seeing it at all because they weren't doing the math.
Amazing. That's such a good point, Tina. Such a good point. What would you say, in the last few minutes that I have with you, what would you say are in terms of breaking it down by price range, right? What is maybe more of the more popular, highest demand price point that you're seeing right now?
I would say, well, our median price right now, median meaning 50% sell above this number and 50% sell below it, is right in the low 300s. And I would say the most popular price point where we've seen a increase in supply, like 65% increase in supply since the COVID event, if you will, has also seen the most demand. So it recovered almost just as fast. So I would say that contracts coming in between 200 and 300,000 are now just as high as they were in February before the whole shutdown, stay-at-home order, all that stuff happened.
Amazing.
Crashes. And so, and that's just below the median. And you still have very good demand between 3 and 350. And demand specifically has remained high in certain corridors, employment corridors, which, by the way, the 202 in the Southeast Valley is an emerging one. And also you've got a very strong one in Chandler, strong one in Tempe and downtown Phoenix. And so those areas all surrounding your employment corridors are doing extremely well for demand.
That's great. Anything else that you would say that you think would be helpful to anybody who's watching this back and just, just kind of curious and overall what is going on? Anything else that you think would be valuable to share?
I would just say you should not be looking at housing as a short-term investment. It should not matter what it's worth next month, next year. What you care most about is where will your equity stake be? How much will you pay down your mortgage in 5 years if your home doesn't appreciate a dime? Look at that. It should be a stabilizing factor. And and I think take some note about the risks of renters. We've seen this now twice. When we had a government shutdown, we had a bunch of government employees who didn't get paid for a month and were at risk of being evicted within weeks, not months, weeks of losing that income. And so we're seeing it now too, where the renters were at much more risk of being evicted than homeowners were being foreclosed on during these things. So being a homeowner, it should be something that is a stabilizer in your life. And also one last thing, in the United States, when you're done with your working life, the vast majority of Americans at retirement have the majority of their wealth in the home that they live in. And so the earlier you start, probably better.
I love that. Oh, what a great note to end on. Thank you so much, Tina. I really appreciate your time and just sharing all of that info. You're wonderful.
Thank you.
Thank you.
Thanks for having me.